Hello. Hello. So it says here the screen share is loading. I guess it's going to take a minute before you can see what I'm doing. Here we go. All right. Very good.
Good evening, Professor. How are you?
Yeah, it looks like you're the first, so maybe we'll wait a couple of minutes. But I do want to point out that now last week when we were looking at strategies, there's a document I wanted everyone to see, and I just couldn't for the life of me find it. So I did finally find it. I put it here at session 5. And
Yes,
I'm going to open it up real fast just so you can see what's in here and why I like this so much. Um,
yeah, we
down,
received a mail, I don't know, 2 days ago, and I was able to see it.
you were. Okay, good.
Yeah.
Okay, great. So in other words, it's not a long document, but it has a very significant number of these strategies, some of which we did look at. And you can see there's so many to choose from. But what I really like about this document is that it doesn't just tell you how to set it up. It gives you this wonderful little graph, but it also explains to you what your outlook would have to be for you to set up this position and
And
what
the-
kind of risk and reward you're taking. It also
yeah.
shows us what volatility does to the position, what happens over time,
But
and
the name, instead of say reverse, it says short or
short. Oh, short in this context, short and reverse means the same thing.
yeah.
Okay. So yeah, those two words mean that you're instead of buying, you're selling for whatever options you're in there. So um, the bull and the bear spread are actually short reverses of each other.
Yeah. Okay.
So yeah, it's kind of interesting. And if you go through the diagrams, you'll say some of these are absolutely insane. You have to wonder why you would set something like this up. Now, there's our short straddle. We looked at that one. Um, and this is the one where you better really mean business because there's no limit to your losses. There's a short strangle. And some of these, by the way, some of these all of the ones we looked at, we're assuming that the underlying asset is the same and the time to maturity and what else do we assume is the same? It's the same asset, the same time to maturity, um, but the different strikes. Okay. So here, though, this calendar spread, you're actually using two options that have different maturity dates. They could be identical to each other, but they have different maturity dates. So that does make it a lot more complicated to analyze it. But you can see here it does resemble quite closely the butterfly spread. But most of the positions are assumed to be based on stocks or options rather that are identical, except that possibly the strike prices are different. So that's much more common. So now look at this one. Oh my God. Now this one, it requires us to own the share of stock as well. Um, I guess this person is assuming that the stock price won't go up very much. They'd like to put some money in their pocket now, but you can see the problem is there's an upside limit and there's no downside limit. So I personally would never set this one up. But you see, the problem is you own the stock, but you're selling the call and the put. So you're putting money in your pocket now, but let's just say that bad things can happen here. This is our old friend, the long butterfly with the calls. Ah, that's it. So, oh my God, now you look at this one. You're basically assuming that the stock will stay away from this part here. It's like a pothole in the road. Okay, so this is what we don't want to see. Okay, but you can see there's a upside limit when the stock price goes down, but on the upside, there's no upside limit. So you can see this individual clearly believes that the stock price will move significantly up or down, but it's more likely to go up because that's where all the upside potential is. And yeah, then we have the put back spread. It's the same thing except with puts. Okay. No, yeah. So anyway, so I just want to make sure everyone knows that that's there. This is the one I couldn't find last week, but now I have this Options Industry Council is set up for basically teaching people about options. So it's worth having this. All right. Anyway, so but also I think I may have mentioned already that if you go to the CME website, you'll discover that they also have their own educational material as well. If you scroll around here, yeah, here it is. They actually have online classes you can take. Well, I mean, they're recordings basically, but you can take exams and you can actually get credit for finishing up all these modules they're called here. And where are they here? Here are courses and lessons. And oh my God, it's a big list. So look at that 789 results. So I'm sure somewhere in here, if you look, let's say, oh, options, but strategies in particular. Yeah, even here, there's 291. And over here, the Greeks will be looking at that in a later chapter. Learning, some of these are very simple, of course. Here's Pocal parity, which we'll be looking at tonight. And oh, there's all kinds of them. Oh my God. So if this is what if you're trying to learn for your job, for example, this would be a perfect way to get a lot of good background in a hurry. So it's there if you want it. Okay. Usually you have to pay for this stuff. All right. Anyway, so tonight is week 5. Now, this week, the material is a little bit more theoretical, I'd say. So because of that, there's no assignment this week because we're just going to learn more of the properties of options. Specifically, we're going to be looking at the relationships between their factors and the value of the options. And yes, at the end, we're going to introduce this concept of Pocal parity, which is a huge deal. I think week 6 is when we actually start to price options. Let me just go confirm that. Now, what's good about that is that it's an awfully important topic and the material is involved, but Excel will help us learn a lot in a hurry without, even though there's a lot of math, we can do it in Excel, and that should help enormously. So week 6, I think, next week, that's right, pricing options. Okay. And then after that, we're going to focus our attention more on risk management. For example, in week 7, we're going to introduce the concept of the Greeks, which are measures that are designed to help us understand how much risk we're exposed to with our options positions. And then in week 8, we're going to introduce this value at risk framework, which was invented about 30 years ago to help understand the risk of a portfolio, regardless of what assets are contained in it. Okay, so for many, many years, there were many risk measures available, but they were unique to certain asset classes. So the value at risk methodology makes it possible to have a portfolio with, let's say, stocks and bonds and currencies, whatever, and still be able to come up with a single risk measure that applies to the entire portfolio. That was never possible before. And so it's an interesting story. And options can be used, as you'll see in this framework, to help us reduce the amount of risk that's in our portfolio. But tonight we'll be focusing on, it's called the properties of stock options. So we're going to look at the factors that determine the value of an option. In other words, when we looked at Apple options last week, let me just go revisit that page. Every one of them has a price. And let me just revisit this page real fast. So unfortunately, I think that this is the only kind of options we can get our hands on the internet without paying for it. And even then, it's only a single day's worth of data. Option data is big business. Nobody's going to give it to you for free. Okay, so let's see. Where are we? Like for example, if you have a Bloomberg terminal where you work, or if somebody does, you know how expensive those things are. That's why Michael Bloomberg is so crazy rich, because everybody has to have one. So he can charge whatever he wants and Wall Street will pay for it. So yes, for example, if you notice for these calls that are due in March, these are expiring tomorrow. Wow. The price is over here. The ask price is the one that we pay for it. And so we'd like to know, where did these numbers come from? Okay. I mean, we're taking it for granted that these are the correct prices, but we'd like to know how this came about. Why is it $1.20 and not $1.50, for example? So we want to understand what factors influence the price of an option. But then options are very different in a lot of ways. And one of them is that there are ranges of values that they can attain. And we can be able to, we can show using arbitrage arguments what those ranges are. Okay, in other words, a lot of the results we'll be looking at tonight can be proven by showing that if these relationships are violated, there will be arbitrage opportunities. And arbitrage, of course, is a technique where you can make risk-free profits by buying something that's undervalued and simultaneously selling something that's overvalued. So that's a huge deal as well, especially with options. And then put call parity is something that really proved to be hugely helpful. When the first option pricing model came out, it was only designed to price European call options. And so the problem was, well, what do we do about puts? Do we need a separate model? And it turns out the answer is no, because there's a very rigid relationship that ties together the prices of European calls and puts, and that is known as put call parity. All right, so we're going to assume that the price of a stock option, at least, depends on these factors. So we've got the price of the asset itself, which is the stock in this case, the strike price, the time to the maturity date, the volatility. Now, this sigma is the Greek letter sigma. Volatility is a statistical measure, and it represents, let me just add this here. Is a measure of the risk associated with an asset. And so specifically with stocks, volatility is calculated as the standard deviation of its returns over time. Okay, so there's, in order to calculate a stock's volatility, one way to do it is to take historical data, calculate the rates of return, and then calculate the standard deviation. And so that number's meant to be an indication of how much that price bounces around over time. So I've actually got a graph here that I've done in the past to illustrate how this works. Suppose we have two stocks, A and B. The one on the left clearly has low volatility because the stock hardly ever changes. The one on the right bounces around all over the place, so it has a high volatility. So the one on the left could be, for example, Con Ed. The price doesn't change very much. There's no reason why it should. The one on the right could be, let's say, Tesla. It's constantly bouncing up and down all over the place. Now, interestingly enough, and we'll see why later on, the higher the volatility of the stock, the more valuable is the option written on that stock. And that's true for both calls and puts. Okay, so another reason why people love options so much is because it gives us a way to manage the volatility in our portfolios, which you couldn't really do with a forward or a futures contract or a swap. The other ones are now the risk-free rate of interest. And I just want to remind everyone that risk-free in this context means free of default risk. It's the yield. It's basically taken to be the yield on a treasury security. Because as you know, when you buy treasury securities, the government guarantees that they'll pay you the interest that they owe you. And unlike a corporation, basically does the same thing. A corporation can go out of business, but the government can't. So very, very occasionally, a national government will run out of money and they'll be unable to pay the interest on their bonds. It happened in Argentina in around 2001. And it was a big problem for Argentina because when you suddenly don't pay, the interest on your bonds, your credit rating goes to the floor, becomes very difficult to continue borrowing money. And in the case of Argentina, the currency collapsed. And it was quite a disaster for Argentina, but they didn't have any choice. They literally had no more money left to pay all the debt that they accumulated. So the IMF had to step in and help them out. And but it doesn't happen very often, but it's not impossible. You don't see it with, let's say, countries like the United States or Canada or Germany or France. So when you buy a security issued by one of those governments, the yield or rate of return is basically guaranteed, as guaranteed as anything can be in this little world of ours. Okay, so when you say that word risk-free rate of interest, it's the yield on a treasury security. The maturity of that security depends on what we're pricing. And you'll see this plays a huge role in option pricing theory. It actually plays a huge role in all derivatives pricing. And you'll see why as we go along. And then for stocks, at least, you also may have dividends. Okay, now the thing about dividends is that they don't get paid out terribly often. In fact, they're usually declared by the board of directors every quarter. So that makes it difficult to put this into our models. So we'll do our best, but as it turns out now, if you look at a source of data like this one, let's take a look at the history of the prices of Apple stock. What they've done here, they come up with this idea that these are the closing prices for Apple stock over the last recent history. What they've done is they've come up with a methodology for giving us what's called an adjusted closing price, which means it discounts for any dividends that might be paid out by the stock. So that rather than fooling, like here we go, Apple paid a 25-cent dividend on February 10th. Now, considering that that stock is worth over $200, you have to ask yourself, why did they bother? Well, there's a lot of potential reasons. If they don't, it'll make the news, and then the stock price will go down, and everyone will be upset. But it's a very small amount. So rather than trying to incorporate dividends into any models you're using, you can instead simply use this adjusted closing price, and then that's it. The problem is already taken care of. So, but here we're assuming that that's not the case. We will have to adjust our pricing models just in case a stock does happen to have any dividends. And the reason for that is because we know from historical experience, when a corporation declares a stock, declares a dividend rather, price of the stock falls by that amount. So if Apple declared a 25-cent dividend, the price would have gone down 25 cents until some other factor came along and changed it. But the immediate impact would be a reduction in the price of 25 cents. And that's going to have an impact on the price of any options. It would be harmful to a call and helpful to a put. So we do have to take into account. Well, all right then. So what I've done here is I put together a little table. And so I wanted you to see how these factors affect the price of a European call, European put, American call, and American put. The plus means that if this factor goes up, the price goes up, and vice versa. The minus means they go in opposite directions. So if the stock price goes up, the value of a call goes up, the value of a put goes down. Okay, which makes perfect sense. Now, by the way, why are we making a distinction between American and European calls? There's only one factor where this matters, and that's the time to maturity. Okay. There's a question mark here because even though typically the more time that we have until the maturity date, the more valuable the option is, there are some very bizarre exceptions when it comes to European options. Okay, and we'll get to those later on. So I guess what we could have done is put usually positive, but there are some conditions under which it could be negative. So in other words, with an option, the longer until the maturity date, the more expensive it's going to be because it increases the likelihood that the option finishes in the money. Okay. Now, if you notice here too, the strike price and the stock price go in opposite directions. They have to, of course. Okay. The higher the strike, the harder it is to make money with a call, but the easier to make money with a put. The volatility is positive across the board. Now, the reason for that is because volatility, let me just take a step back here. Volatility increases the likelihood of extremely high and low stock prices. All right, let me just sneak this in here. Higher volatility increases the likelihood of extreme outcomes, as you can imagine. So in other words, now how does this help an option? This is beneficial to an option because whether it's a call or a put, of the fact that it has limited downside potential and unlimited upside potential. So anything that increases the likelihood of extreme outcomes adds more value to the option on the upside than it subtracts on the downside. So I'm trying to think of a good analogy for that. Imagine you're playing, you're involved in some game. I'm trying to make up a very strange example. Suppose you are playing a game where for some reason, heads flipping a coin where a coin is flipped. Well, this is not a good example because the coin's probabilities never change. Okay, how about this one? Suppose you're playing a game where you are betting on the weather or tomorrow's temperature. That sounds better. And the way the game works is that if the temperature is above 70, you win $5. If it is below, let's say 50, you lose $1. If it is in between, you win nothing. So in a game like this, the last thing in the world you want is for your temperature. So let me illustrate this on the next page. So the temperature is constantly staying in this range, you end up with no money. Okay, let's say this game goes on and on every day. Every day we bet on the temperature. If it goes above 70, we make $5. If it goes below $1, we lose $50, we lose $1. And in between, we just keep breaking even, zero. So if volatility of the temperature goes up, it adds to the probability that the temperature will be very high or very low. So you see why that would be helpful to you, because when it goes way up, you'll make $5. But when it goes way down, you only lose $1. So if you're adding to the likelihood of being in either here or here, either extreme case, that's on average going to add value to your bet or to your winnings. Okay. So if the temperature becomes more volatile, it adds to the chances of winning $5 or losing $1. So that means that on balance, you should be benefiting from this. The last thing in the world you want is for the temperature to stay very stable between 50 and 70, because then you never make any money. So the higher the probability of it moving into either extreme, the more money you're likely to make. And so the volatility is helping us because the upside is higher than the downside. Let's put it that way. All right. I hope that helps understand why volatility is helping the options, because again, in the imbalance between the upside and the downside. Well, anyway, and then let's look here. Now, the risk-free rate of interest is helpful to calls and harmful to puts. And we'll see why that is later on. Okay. And then dividends, because of the fact that they lower the price of a stock, will only be harmful to a call and helpful to a put. Okay. So I'm hoping this table makes sense. This is the only one that needs a little explanation. And even then, this question mark, think of it as an extreme case. It's not something that happens very often, let's put it that way, but it's not impossible. Okay, so the stock price. So if you remember with a call, the payoff is the maximum of S minus X and 0. Okay, let me add that to a new slide. It's getting a little cluttered here. So X is a constant. So if S increases, that means that S minus X increases. And the payoff rises. And of course, that means that the price of the option has to go up too. Okay, with a put, since we're subtracting S, if S increases, subtracting a larger number, X minus S decreases and the payoff falls. Okay, so notice here in a nutshell, just in terms of pure algebra, is why this first row is true in our little table. Here we have a plus, but these are both pluses and these are both minuses. Now, the X's just go in the opposite direction. The X goes in the opposite direction of the S. If S goes up, it's the same thing as the strike going down and vice versa. So that's why these always have the opposite signs. Now, the time to maturity, as we saw before, the longer the time to maturity, the more valuable it is because of the fact that there's more time for the option to move, either finish in the money or move more deeply into the money if it's not already there. Now I think I started to draw, we're going to see some interesting graphs here, but what they're pointing out here is this. The reason why this might not be the case with a European option is because if you have an option that's deeply in the money, let's see. I think I drew this graph last week. And we'll see more of this later on when we start pricing options. But if you were to try to match up or draw the payoff against the stock price, it turns out that on the maturity date, the call price matches the call payoff. Any other time, any time earlier, let's say, call price exceeds the payoff. even if it's just by a penny. At any time prior to the maturity date, the market price has to be higher. So if you were to, let's say, draw the relationship between the price and the stock price at, let's say, 3 months prior to maturity. Actually, I'm gonna try to fix that. It should look more like this. Okay, that's a little better. So let's say the stock price is here. I'll just call it S star. So the payoff is this number. The market price is here. So the gap between these two is referred to the options time value. And that represents what the premium you're paying for the fact that there's a fairly long time to the maturity date, and the option could become more valuable before the maturity date. Now, and by the way, I think I mentioned this last time too, as time elapses, what starts to happen is, say green is the call price 1 month to maturity. And so as time elapses, the market curve will shift closer and closer to the payoff profile. And on the final day of trading, the two will be identical to each other. So now, as far as the time value, so you can see what this is telling me is that as time elapses, the value of the option is actually shrinking, or specifically the time value is shrinking. But there is one exception, or there's one or two, but let's look at one of them. Now, I'm going to do the same thing with a put. The put is the one where there can be a discrepancy here between European and American. So if I do the same diagram for a put, so I'm going to draw two graphs in here. The market price of a American style put and a European put. Now, remember, the American put is always worth more. I'll try this raspberry. So it's hard to be sure without more data how close they are to each other, but this is the part that we want to focus on. Oops. When we get to the end there, I'm going to magnify this, by the way, real fast, so you can really see it. Reserve payoff profile. So the American style option, which is red, cannot fall below this line. And that's because of the early exercise feature. If the value of the put rather, does fall below the payoff, we'll just exercise the option early. Okay, so we don't have that privilege with the European put. Now, so here you could run into this situation. Be down here, the put is deeply in the money. So what this is all about is this. When an option is very deeply in the money, the chances of it being exercised are essentially 100%. Okay, there's essentially no chance they will not be exercised. Now, here's the problem with that, though. And here's why this is happening with the European option. Oops, exercised is about 100%. So a European option cannot be exercised or so suppose that the option will mature in 1 month. By being unable to exercise the put now, the owner is losing the opportunity to exercise the put and invest at the risk-free rate of interest until the maturity date. All right, so if you own that European put, you would love to exercise it, collect the payoff, and then invest it at the risk-free rate for the rest of the lifetime of the option. That value that you would gain by doing that will be greater than any potential benefits from holding on to it to the maturity date, because you're basically already so deeply in the money, you can't get any deeper into the money at that point. So you're losing the opportunity to say, listen, I'm going to just exercise it now and just put the money in a treasury bill and earn interest until that maturity date. But with the American style option, you can do exactly that. You can say, listen, I mean, this option is so deeply in the money, it will do me no good to hang on to it any longer. So I will exercise it early, invest the money at the risk-free rate until the maturity date. And that's a benefit to me that I don't get with a European option or European put. So that being the case, when you're that deeply in the money, European put could actually be losing value as we keep holding on to it because of the loss of the time value of money. So that's the reason why this one oddball case can take place where the passage of time is actually helping this thing. So that, by the way, that's why these question marks are here. Extreme case, that's what it should say here. You don't see this very often. Most of the time, these should be pluses too. Okay, it's just that rare exception. Like, for example, when a put is deeply out of the money, it can happen with a call too, but there are other circumstances that have to hold. But so this is very unusual, but possible. For all practical purposes, as time elapses, the time value of money, the time value of the option tends to decline. And by the way, when we're studying the Greeks, this topic will come up again because the Greeks tell us how sensitive the options price is to changes in these factors. And so we'll have this conversation again about why these numbers these are question marks. Now, the volatility, as we've already discussed, the reason why it helps options, whether they're calls or puts, is because it increases the likelihood of extreme outcomes, which adds more to the upside than it subtracts on the downside. So on balance, we're benefiting from higher volatility. Now, with stocks, that might not be the case. You know, you might find that stocks are losing value from high volatility. If the markets are in turmoil, the stock market doesn't tend to do well. But on the other hand, gold tends to do very well during periods of high market turmoil. But options always benefit from volatility, whether they're calls or puts. Actually, I have this little, I don't know if this is going to make any sense or not. You're seeing these two curves, by the way, represent the normal distribution, which we'll discuss at a later date. If you haven't already seen this in statistics class, this is the distribution of the underlying stock. And in the black case, it has low volatility. In the green case, it has high volatility. So with this red payoff profile, the idea here is that the high volatility, you're adding, increasing the likelihood of finishing in the money. But it also increases the likelihood of finishing out of the money compared to the black curve. But we know that there's a limit to how much we can lose. If it finishes out of the money, you just end up losing the amount you paid for the option. On the upside, there's no limit to how much you can make. So on balance, this benefits the option because it, like I said, it adds a lot more to the upside. There's only a limit to how much you can add to the downside. So we like volatility in the options markets. In fact, sometimes when people are buying options, the reason why they're buying them is not because of the asset itself. They're betting on volatility. They're saying, listen, volatility is rising. We'll just buy an option. And that if we're right, that will help us make money. By the way, just as a side note here, um, interesting thing about the derivatives markets is that they evolve over time according to market demand, as you can probably imagine. So a lot of these products were created as in response to a perceived need for them. But there's this one special type of asset you may not have ever heard about. It's called the VIX index, which stands for Volatility Index. And this is sponsored by the Chicago Board Options Exchange. And it's only been around since the late 90s. Let's see. Oh, here it is. So the St. Louis Fed, they have this economic database called FRED. And so this is what the VIX index has looked like over the last, let's say, 5 years. So what they've done here, they've created an index. Think of it as the volatilities of Standard & Poor's 500 in options. And so if you look carefully at this number, it tends to bounce around when things are going badly in the economy, in the in the world. When there's a lot of turmoil in the world, it goes up. Like during the COVID, for example, it went to the roof. When things are calm and normal, it goes down. So you as an investor can invest directly in the VIX. You can buy an option on the VIX. You can buy a futures contract on the VIX. You can buy a futures option on the VIX. You can also buy an exchange traded fund that replicates the VIX. So why would you do that? Well, let's say you think that there's going to be a lot of turmoil in the market for the next few years. You're like, I don't know what stocks to pick, but I do know there's going to be a lot of volatility. I'll tell you what, why don't I buy an option on the VIX? That way, if there is more volatility, I'll make a lot of money. So this was only created in the late 90s. There's a professor of finance at Duke University named Robert Whaley. He published a series of papers in which he explained why he thought there should be such an index. And eventually the Chicago Board of Options Exchange said, you know, Bob, you're right, we should have a VIX. And so we'll put it together and it'll be available to all investors going forward. So if you go back to the max, it only goes back to 1990. And during recessions, you can see, or during the COVID and all these disastrous years, this is when it tends to go up. The rest of the time, it tends to float around at relatively low levels. So if you're thinking about looking for a very exciting new investment opportunity, where you only have to think in terms of volatility, this is a possibility. Okay. All right. Now the risk-free rate, what does this have to do with anything? Well, this has to do with the nature of a call and a put is that just think about it this way. Owning a call on an asset, such as gold, means locking in the price. Let's say at which you can buy the gold without the need to actually own it. Notice you buy coal and gold, you have the right to buy it in the future at a fixed price, but you don't actually need to buy it right now. Okay. So another way to lock in this price is to buy the gold today and hold it. Now, the only unfortunate thing about that is that this means tying up funds that could have been invested. So imagine yourself plunking down, what is it, 20, price of gold is absolutely going through the roof. Let's see what it is today. Oh, for God's sake. There it is. Oh, it did go over 3,000. I don't know if that's, I guess that's a record, isn't it? Ooh. Yeah. But anyway, so there's gold. I wonder how the markets react to that. Hold on one second. Usually the thing is about gold is when gold goes up, that usually means things aren't going so hot in the economy. Well, all right, these by the way, if you've noticed, if you try to look at these stock market indices after trading hours, you notice how it says Dow FUT, S&P FUT, NASDAQ FUT. Those are futures contracts. They're trading overnight in overseas markets. So as we speak, traders in, let's say, Asia, yeah, it's too late for London, I think. For Asia, are actually buying and selling these contracts. So they're basically giving us inside information as to how traders are perceiving the markets. So that when the markets open up tomorrow, you'll see these prices sitting here and it'll give you a sense of where these traders expect the market to go tomorrow. They're basically giving us a forecast. Like here, they're expecting small gains. Okay. So, the markets have been in the doldrums recently. So, I don't see any mention here about gold though. Let me just see. They often have separate articles here. Oh no. I thought they had everything. Oh, I guess not. But it's got to be close to a record. I think the Fed chairman opened his mouth and basically implied that he's not going to cut rates anytime soon, and that never helps. But anyway, oh, here it is, right here. Gold pauses for breath after a record run at safe haven demand. A safe haven means that people are getting nervous and they put their money in gold instead of other traditional assets. So it's sometimes called a flight to quality. Wow. So gold and silver went up. Copper is an industrial metal, so it doesn't often go in the same direction. Platinum and palladium are the two white metals, as they're called. And they are typically quite a bit more expensive than silver, but not nearly as expensive as gold. They're also elements. These are all elements. Remember from high school, the periodic table of the elements? Um, that was fun, wasn't it? Yes, it was. You're allowed to admit it. You memorized at one point in your life, you had all these symbols memorized. Remember, gold was AU and silver was AG. And yeah, you at one point in time, you were intimately familiar with the periodic table of the elements. Just as an aside, I've discovered this because I'm constantly dealing with college students. since we were in high school, they've added a bunch of new elements. The table used to go up to, I think, 104. Now it's like 119 or something ridiculous like that. And not only that, but they've decided apparently that our neutron isn't really a subatomic particle at all. It's like a bunch of smaller ones that, so we're kind of losing touch with all this science. Okay. But anyway, but so here's the point of this. If I wanted to hedge or lock in the price of gold today, I can either just buy a call or I can simply buy the gold now and store it. Even if I don't have to pay any storage costs. Let's say I have a safe in my house. Those are funds that I could have used to invest and earn at least the risk-free rate of interest. So having a call means that you do not have to pay any financing costs for this gold. And so that being the case, since owning a call saves the investor from financing this position, the benefit increases when interest rates rise. So in other words, the higher the rate of interest, the better this works out for you as the owner of the call. That means that you're saving even that much more money from not having to finance your position. So let's go back to our table. Oh, yes, go ahead.
Going back to the financing of the position, are you basically just saying it's cheaper? It's cheaper to buy a call option for X amount of contracts than buying the gold outright. So that just saves you that capital to finance it.
Right, because you may not have the funds in the first place, and then you have to finance your position. So you're probably better off for the call, but the higher rates are, the more beneficial it is to own the call rather than the spot position. Okay, so that's why R is plus here. But with a put, it's the other way around. The put gives you the right to sell the gold. And so let me sneak this in here. A put enables the investor to lock in the price at which he or she can sell the gold future. So now here's the thing though. With the put, selling the gold takes place in the future. And, well, I guess you could actually buy it if it's an American option, then that makes it a little easier. But selling the gold takes place in the future, so that there's a delay in receiving the proceeds of the sale of gold. So the higher the rate of interest, the more disadvantageous this is to the investor. So yes, go ahead.
If the price of gold blows past the put price, the pro strike price, then you lost your money, right?
Yes, that's right. So if you have a strike of 2,800, right now you're pretty upset. Because you can see the gold went up to 3,000. So you're not going to sell your gold for 2,800 if you can sell it in the market for 3,000. So yeah, that put would actually be out of the money, of course.
Right, exactly. That's why you're hoping on volatility over 6 months.
Right. So if you like are able to forecast volatility into the future, and you can see something happening, we know that historically gold responds well to volatility. And with, let's say, even for any really new administration coming along, there's a lot of uncertainty in the early days. And so that would tend to raise volatilities in the market. And that in turn tends to benefit gold because people get nervous, they buy gold, even though it doesn't provide any source of income. They may decide, if push comes to shove, the gold always has a value. And it's always been like that. It's always been seen as a safe haven. So a lot of the demand for gold comes from fear, really. It's, it is, of course, uses it. In an industrial metal, we do see it used in industry, but a lot of it is held for purely investment purposes. So, by the way, just in case this isn't really part of the course, but I just wanted you to be aware, if you haven't seen this before, if you go to the New York Fed, let's say that you're fortunate enough to get on a tour of the New York Fed. They have something very interesting in the basement of the New York Fed. And that would be this. Gold. An enormous amount of foreign gold is stored in the basement of the New York Fed. Now, in principle, you can get on a tour of the New York Fed, but it's not easy. During the summer, I teach a class for high school students in which we do go down there and visit the Fed. And it's a lot of fun for everyone. So it's very secure. The bars are just sitting there in these lockers. They're not identified. We're not supposed to know who belongs to what gold, but we can at least look at it. The current market value, or the last summer, the market value of this gold was something like $350 billion. And I'm sure it's been a lot more now. But most of this gold belongs to other countries. In fact, I think all of it does. So it raises an interesting question. Why is it down there? So the reason for that is because a lot of that gold was placed down there just before World War II, because a lot of the countries were very nervous about what was happening in Europe. And they decided it would be safe to ship the gold to the United States for safekeeping. And when the war was over, they realized, you're doing us a huge favor here by storing this gold for us. And the Fed doesn't charge a fee to these countries to store their gold either. So they said, why don't you keep it? If we need it, we'll let you know. And so it's still sitting there. Now, during the period right after World War II, we had a system called the Bretton Woods Agreement, where countries would settle their international deficits with each other in terms of gold bars. And so what could happen then is that, let's say Germany and France's lockers are right next to each other. If Germany owes France money, they can have some of the bars transferred from the German locker to the French locker. So it served a useful purpose at that time during the Bretton Woods Agreement, making it easier to transport the gold between the countries rather than physically shipping it back and forth. But the Bretton Woods system ended in the early 70s. And since then, there's been no real need for the gold. So it just sort of sits there and the countries don't ask for it back. It's very safe. And in the United States, our gold is kept in Fort Knox. That one you can't go on a tour of. That's no. But this one you can. Okay, and it's quite a sight, I must say. You'll never forget that as long as you live. It's not just any gold; it's monetary gold, which means it's as pure as it gets. These could have been used for coins, 100 years ago. But anyway, I thought you'd find that interesting. I just thought of it when we were talking about gold. So yeah, the vaults are pretty secure, as you can see there. All right, anyway, so let's get back to this. Now, so yeah, these are some more examples that are basically explaining in more detail what we just talked about. An investor needs to buy gold in 6 months. In order to hedge this risk, he can buy the gold now, or he can buy a call option on the gold today. Even though he has to pay a premium to buy the gold option, he also saves the interest that would have been required to finance this position for 6 months. So usually it's cheaper to buy the call. And so the higher the rate of interest, the more advantageous it is to have a call. But if you need to sell gold in 6 months, you could sell it now and invest the proceeds, or you can buy a put. So Buying the put means you're postponing the opportunity to sell the gold and earn the interest. So that being the case, the higher is the rate of interest, the greater is the sacrifice incurred by owning a put instead of selling the gold outright. So that's why these, let's go back to the table. So that's why the risk-free rate going up is helpful to a call, but not a put. And the dividends are pretty straightforward. Like I said, because the declaration of a dividend lowers the price of a stock, that means that obviously is going to be harmful to a call and helpful to a put. All right, so I think we get these factors rather. Now we're going to look at some interesting results. These are more theoretical results. Now, all of this discussion leans very heavily on the concept of arbitrage. Now, arbitrage, like I said, simply means let me introduce a very quick, simple example of what arbitrage is all about before we do anything else. And you know, the type of arbitrage that we can engage in depends on what market we're dealing with. So the concept of arbitrage is quite integral to everything we do in option pricing theory. And arbitrage is a process through which risk-free profits can be earned by simultaneously buying an undervalued asset, selling an overvalued asset. Okay. Now you're probably thinking, well, how would that happen? In an efficient market, this is not going to happen very often, if ever. But let's just say one day you're looking at the Wall Street Journal and you realize something interesting. Suppose that we discover in New York, the dealer gives a quote for gold of $3,000 per ounce. London, a dealer gives a quote of, let's say, 1,800 pounds per ounce. The exchange rate is currently $1.50 per pound. Fine. So what's the big deal? Well, if you were to convert that London quote into dollars, you'd notice something very interesting. The London price of 1,800 is equal to $2,200. All right, well, it wouldn't be that far off, but let's just say this is what we discover. So in other words, the gold is overpriced in New York, relatively overpriced, and relatively underpriced in London. They're only asking 2,200. Oh wait, that's not right. That's 2,700. Sorry, no wonder it seemed way off. Okay, it's still a huge discrepancy, but before it was a bit ridiculous. Okay, so in other words, you can see, well, wait a minute, I should be paying the same amount in both countries, shouldn't I? Yes, of course. So here's what's going to happen. A smart trader will do the following. Trader will buy gold in London for 2,700 per ounce, and then resell it in New York for $3,000 per ounce, earning a profit, a risk-free profit, that is, of 300 per ounce Now there could be transactions costs. I'll call it before transactions costs. But still, it's a profit. And this profit arises from the inconsistency in the prices in the two markets. So in other words, an arbitrage results when there's a mispricing of some kind. Now, of course, this will disappear very quickly because as everybody else sees that they'll start buying gold in London, the price will go up. They'll sell it in New York, the price will go down, and pretty quickly the prices will match again. So now in what we're doing here, we're going to apply it slightly differently. We're going to assume with what we're doing here that arbitrage, well, first we'll say arbitrage can be applied in many different ways. With option pricing theory, we will assume that if two assets are guaranteed to provide the same cash flow at some point in the future, they must sell for the same price today. Otherwise, arbitrage will take place. Okay. So in other words, if we have two, let's say, portfolios of assets whose cash flows will line up at some point in the future, their prices will have to be the same today. Otherwise, we buy the one that's cheaper, sell the one that's more expensive, and the profits will go into our pockets, and we'd have no exposure to the assets in these two portfolios. So we know that that's not likely to happen, or so it'll be exploited almost immediately. Okay. So that's going to be at the heart and soul of a lot of the analysis we'll be applying in this chapter. So we're going to establish some limits on the prices of options. And these are theoretical limits that are enforced by this principle of no arbitrage, meaning that prices have to be consistent with each other in order to avoid arbitrage. So if they're not, arbitrage will take place and it will put these prices back in alignment with each other. So some of these are just pretty much common sense. Some of these we have to go through a lot of trouble to prove them. So here's an example. So using the notation that lowercase c is a European call and uppercase c is an American call, what they're telling us here is that the European call is always worth less than or equal to the American call, which in turn is less than or equal to the actual stock price. Okay, in other words, it'll never make sense to pay more for an option on a stock than the stock itself. Of course, that intuitively makes sense. The question is, how do we prove that arbitrage will result if this condition were violated? Okay, so what you have to do is imagine what steps you would take to buy whatever's too cheap and sell whatever's too expensive, and how much money would you make? All right, well, let's find out. So let's say that if some reason the American call is actually more expensive than the stock. Now we're basically claiming here that this would lead to an arbitrage profit of C minus S, which is positive. Because here's what you could do. If you look in the Wall Street Journal and find this to be the case, you're going to buy this stock because it's underpriced or undervalued. Oh, let me turn that back to black. You buy the stock because it's too cheap. and then you write or sell the call because it's too expensive. So what's going to happen now? So first things first, today we collect the difference between the two. Okay, so the positive cash inflow is equal to C minus S, which we know by assumption is positive. But yet, when the maturity date of these, the option at least rolls around, there's only one of two possible outcomes. If the stock is greater than the strike, then your position, and by the way, look up here, you can see our position is S minus C because we own the stock and we've sold the, or written the call. So on the right-hand side, you can see I've rewritten C with the payoff, max S minus X and 0. Okay. That's what our position will be on the maturity date of this option. So in the first case, if the option finishes in the money, we exercise it, we receive a payoff of S minus X, but sorry, the person we sold it to has a payoff of S minus X. So if you write algebraically S minus X, you'll see that you end up with X as your net position, which is guaranteed to be positive. But if this option finishes out of the money, you just end up with the stock. And that's also positive. Now, this is very unusual. Yes, go ahead.
So in this scenario, we're buying a stock
Mhm.
and then you're writing the call. So essentially you don't believe this stock to hit the actual strike price of the call, or you're buying it with the intent of it hitting the strike price.
The thing is, we don't care. That's the beauty of this setup. We don't care. If that call price rises above S, it doesn't matter what happens in the future, we're still going to make money.
Right. You make money by the difference between where you bought the stock and then the strike price where you sell it. Plus, you've made the premium on writing the call.
Right. And then in the future, when the option matures, our position is guaranteed. Now, normally at this point, in most cases, our position is guaranteed to be 0 because usually the two positions offset each other. But here, it's such an extreme case that we're actually going to have money at the end too. So the most important thing is that you have money coming in today, and at best or at worst, you have no money going out of your pocket in the future, and that's an arbitrage.
But how do you determine if the stock is underpriced and the call is overpriced?
Just a mere fact that the call is more expensive than the stock. That's enough. That's all it takes.
You're saying that the strike price is more expensive, or
the call itself, like
the call premium.
That's right. Yeah. So in other words, let's look over here. Imagine if here the most expensive call is oh wait, sorry, those aren't the calls. The most expensive option in this list is 211. Oh God, what happened? I think they want me to pay for something, but I refuse. 211. Now you notice the stock price is 214.10. Let's say you look in the Wall Street Journal and you say, wait a minute, the call price is at 215. That's more than the stock price. You see, so it's only 211 here, but what if it actually went up to 215 for some reason? Then you would do this. You say, listen, call is overpriced. The stock is underpriced. I'm going to buy the stock and sell the call. And by doing that, I'm not only putting money in my pocket now, which in this case would be the difference between the 215 and the stock price. So I've made 90 cents right up front. And then when the option matures, in this case tomorrow, I'll be left with either the strike price which means a positive amount, or the stock price, which is also a positive amount. So I've got money coming in today and again at the maturity date. But like I said, usually the way it works out is you get money now, and in the future, your net position is 0.
But in order to write that call on, let's say, Apple, you have to be able to buy $21,000 worth of Apple stock because you have to have at least one contract, which is 100 shares.
Yeah, that is true. The option is usually written for 100 shares rather than just one. So yes, you would have to buy, um,
The rub.
well, yeah, because otherwise when you write the call, you're actually writing it on 100 shares. That is very true. You have to scale this up by 100. So, I mean, this is not something you and I are going to do. This is what traders are going to do. But yes, the principle is the same, whether it's a single share or 100 shares. But yes, it's true. These, if I call a broker and say, listen, get me one of these Apple options, um, for let's say 2.63, it's actually going to be $263 because that means per share when there's actually 100 shares underlying a typical equity option.
Does it make more sense to, if you have the money, to sell a cash secured put where you collect the premium, and if you do get exercise, you can then write a call against the position and then collect the
It depends.
premium there as well?
Yeah, but I mean, it really just depends what you expect to happen in the future because there's no arbitrage going on there. You're placing a bet on what you think will happen. Um, it's all about what you think will happen in the future. These are different though. These are arbitrage opportunities. Every single trader on the planet will see this and say, you know what, we better jump in there and buy that call and sell that stock. I'm sorry, buy the stock and sell the call because this is guaranteed to make us money today and will not lead to any losses in the future. So if you're working as what are these things? The statistical arbitrage hedge funds, they have computers programmed to look for these momentary discrepancies in market prices and jump in and exploit them as soon as they take place. So I guess hedge funds have sort of lost their luster, but they still do exist out there. And some of them are focused on looking for these arbitrage opportunities. It's a tough thing to do, though, because markets are so efficient. But if you're looking at enough data, you may find one eventually, and then, but it only lasts for usually a nanosecond, let's say. So the computer has to be programmed to jump in and do the actual trading. It's gotten to the point where it's too fast for human beings anymore. So that's there are funds whose purpose is to look for these types of opportunities, not just in the options markets, but everywhere. Yeah, there's all kinds of possibilities. You hear about things like tax arbitrage, like bonds that have different tax treatments. Maybe if you buy one to sell the other, depending on what bracket you're in, you can actually lock in a risk-free profit. But so here, now, of course, what are the chances of this happening? Not very high. But it's a perfect example of what an arbitrage means. And so what this does is it guarantees, well, it means that it's extremely unlikely that this price will creep above 214.10 because that means boom, arbitrage, the traders or the hedge. Oh, I'm sorry, Shauna Lee, what did you want to ask a question?
I had a question. I kind of forgot. Oh, the question was, so would the arbitrage opportunity leave once enough traders buy the stock and sell
Absolutely,
the
absolutely.
call? Sorry.
That's right. Yes, there's no question about it because as in the process, whatever people are buying the price will go up, and whatever people are selling, the price will go down. And so it should take care of itself really almost instantaneously. Because the prices won't just stay where they are. All this buying and selling will force them back together. So that's why computers have to be programmed to do this because the opportunities will probably disappear so quickly. By the time you blink your eye, it's gone. Okay, it's at that point right now. But now imagine though, it's not 2025. What if it's 1975 and you're getting all your information from the telephone? All right, you don't have computers all over the place. You don't have the internet. What do you have? You don't have cell phones. You've got phones, telephones. You call up all these different brokers and say, what do you got for this? What price do you have for that? And if you discover that two of them are inconsistent with each other, then you can jump in and make some trades and make money at their expense. And there used to be people on Wall Street whose job was arbitrageur, and that's what they would do. But it's not really feasible anymore, except for these incredibly high-powered computers that are set up by hedge funds typically to look for these very, very temporary discrepancies in market prices. So I'm sure it'll never get to the point where there's no arbitrage, but finding it is just going to get more and more challenging going forward as markets become more efficient, computers get faster, software gets more sophisticated. In fact, once AI starts getting involved here, you may never see it again. Yeah, I guess it's getting to the point where no matter what activity you're discussing, you have to think about how would artificial intelligence affect this, because it's everywhere now, everywhere. I actually have on my phone this artificial intelligence app where, let's say I've decided to buy salad at the deli, and I sit it down in front of me and I'm like, Jesus, how many calories are in here? I can just take a picture of it and it comes back and it analyzes it, says, all right, here you go. And it tells me I've got all these tomatoes and onions and lettuce and
What's the
blah,
name of
blah,
that
blah.
app?
Oh,
Don't gatekeep.
yeah, you'll like it because it takes a picture. You take a picture, it looks at it and it analyzes all the ingredients and it comes back and says, here you go. Here's your calories, here's your proteins, this and that. The thing is, you can't really realistically do it yourself because it's all jumbled together. Somehow it figures it out. I've noticed that it almost never makes any mistakes. It's called now, all right, it's so bizarre. I'm gonna have to write it down on the screen here. I found it purely by dumb luck on the internet the other day, and I said, "Oh, that looks like fun." I don't remember if I had to pay for it or not. I have to tell you that right up front. I probably did, but Ito with a little pretentious accent over the O. If you get that for your iPhone, you can take a picture of anything you're eating, and it'll, within a minute or less, it'll show you exactly what you're eating. It's uncanny how it works. It's like, how is it possible? How can it tell there's pickles hiding underneath all that lettuce? I don't know, but it does it. It knows everything. Yeah, but it's artificial intelligence. I mean, it's okay, it's sifting through all those photos it knows, and it comes back with the results. It's unbelievable. Anyway, so now once you get this, now if you notice, there's a comparable version for puts. Here we're seeing that the American put is worth less than the European put, or at least less than or equal to, and that in turn is less or equal to the strike price of the option. So the way you prove this is the same thing. You say, well, what would happen if this was not the case? What happens if P is greater than X, let's say? So now, by the way, this one is a bit of a stretch. What you have to do for the strike, the strike price is not an asset. So what you're going to do instead is you're going to sell the put. So here, what you have to do is figure out the price of a treasury security. That will be worth X dollars on the maturity date of the option. I don't know if I have an actual numerical example here or not. If not here, we will find one later on. So let's just say that that amount happens to be $100. Fine. So what I would have to do is invest $100 in a treasury bill. So you're selling the put and collecting the proceeds using the X, buying a treasury bill worth X dollars, where it's worth today the present value of X dollars. It'll be guaranteed to be worth X dollars on the maturity date of the put. So that means you're putting the difference in your pocket. So today's cash flow is P minus X, which is positive by assumption. We'll see this again and again throughout option pricing theory. Whenever the X gets involved somehow, we have to replicate it with a risk-free position in a treasury bill. So you're buying the treasury bill that's guaranteed to be worth X dollars on the maturity date of the put. Okay. So, let me leave it there so you can catch up. And so what happens on the maturity date of the put? Well, again, there's going to be two scenarios. In both cases, we end up with a non-negative cash flow, meaning it's either zero or positive. So that's the whole point of an arbitrage. You have risk-free profits coming in today, and in the future, you have either no money or positive money. You never have any losses. So, okay. That looks very messy. Let me just see if I can simplify it a little bit. So P is greater than X. So buy a treasury bill. Sell the put or write the put. So on the maturity date, once again, there's only two things that can be true. In the first case, the put finishes in the money. So but you're now the buyer of the put has a payoff of X minus S, but you're the seller. So in other words, this is the payoff to the buyer. So therefore you have negative. But remember, you do own the treasury bill. So you end up with S, which is clearly positive. In the second case, the option is out of the money. So you end up with 0 plus X, which is X, which is again is positive. Okay. So again, you've got a situation where we're putting money in our pocket today, and we're guaranteed to have a positively valued position in the future. That would be an arbitrage. Okay. Now, we don't want to, there's so many different conditions we could derive this way. And there's several more in the slides, but I want to make sure that we do not overlook really the most important one, which is the so-called put-call parity condition. Okay. So in other words, yes, there's a few others here, but like you could do all kinds of crazy things with these no arbitrage arguments. For example, you could show, let's say we have two calls whose strikes are $10 apart. You could show the range within which they have to trade using these no arbitrage arguments. You can do all kinds of things with this type of setup. But what I would like to do is, in case we run out of time, I'd rather jump ahead. Oh boy, there's a lot going on here, but I want to make sure we do not run out of time for the put-call parity condition. There's also proof in here that if the asset underlying a put option, I'm sorry, call option, has no cash flows, then an American call would never be exercised prior to maturity. So we'll get back to that in a bit, but first let me make sure. And you can see we've got all these upper and lower bounds for calls and puts, which are derived in exactly the same way. And we can come back to these later on if we feel the need. What I would like to point out, though, that if the stock pays a dividend, that we have to adjust these in the following way. Okay, I'll give you a minute to catch up. I'll show you what you would have to do to these bounds if there are dividends involved. Okay, are we ready? Now, if there are dividends, then you can see we've had to either add or subtract D from this equation. Okay. All right. So it turns out, and again, this is sort of a kind of a bit of a preview of next week when we're looking at pricing issues. The original in the thing about options is that they're very complicated to price, as you can probably guess. There's a major challenge. For decades, people were trying to find a way of pricing options. And so in 1973, I'll just throw a brief history lesson in here, which we'll see again next week anyway. So pricing options has proven to be a major challenge over the years. But in 1973, a path-breaking paper was published, which introduced the Black-Scholes option pricing model. It proved to be a pretty important model because the developers of this model eventually were awarded the Nobel Prize in Economics. That's how important this turned out to be. Now, this model was only designed, though, to price European call options on non-dividend paying stocks. That's all it was for. Okay. So you're probably figuring, well, that's pretty restrictive, isn't it? And of course, the answer is yes, but they suddenly, for the first time in history, it was possible to use a formula to price a European call option. Before that, nobody really knew what was needed to be done to price options. Once this paper was published, as you can imagine, the volume of trading in options went through the roof because suddenly it became possible to price them properly. By the way, I do want to mention a couple of other things here. And again, we'll discuss more of this next week when we're looking at these models, but the paper was actually written by Fisher Black, Myron Scholes, and Robert Merton. So even though it's called the Black-Scholes model, Robert Merton was a major contributor to the paper. He came along after they got started writing this thing. And these are heavyweights in the field. This is Fisher Black was teaching at MIT, I think. Myron Scholes, I think, was at Stanford, and Merton was at Harvard. So these are some heavyweights in the field. And in fact, apparently when they were done with the paper, they offered to call it the Black-Scholes-Merton model. And apparently Robert Merton was very self-effacing, I guess. And he said, nah, don't worry about it. I know that I worked on it with you guys. So anyway, it became known as the Black-Scholes model, although in Hull, he does call it the Black-Scholes-Merton model, I guess in honor of Robert Merton. Now, unfortunately, by the time the Nobel Prize Committee got around to them, Fisher Black had already died. So the Nobel Prize was actually given to Scholes and Merton. But anyway, here's the thing. The model made it possible to obtain a quick price for a European call option on a non-dividend paying stock, as I just said. So now it turns out that this framework is not suited for American options. Something else came along later that was used for American options. Also, Merton later on wrote a series of papers in which he showed how to extend this option, this model rather, to other types of options, meaning like options on currencies, options on stock indices, you know, that kind of thing. But here's the big breakthrough that we're about to see. In order to price European puts on a non-dividend paying stock. And I don't know who came up with this idea. I don't think anyone actually knows. We must use put call parity condition. So in other words, what this is saying is that once you know the price of a European call option, you can price the equivalent put with the same strike, maturity, and underlying asset with this special put call parity condition. Okay. So what is this special condition all about? And it's a good thing too, because otherwise they would have needed to invent a new model just for puts. Okay, so that didn't happen because of this put call parity condition. So here's what it looks like. Let me jump ahead and show you, or I'll write it down here. By the way, the word parity means an equality of some kind. It's usually written like this, but if you want to, you could rewrite it like this. So we know all these variables. S is the underlying stock price. So keep in mind, the assumptions we're making here is that the call and the put are both European style and they're identical to each other, except for the fact that one's a call and one is a put, meaning they're written on the same stock S, they have the same maturity date T, let's see. Yes, the same asset, that's right. And they have the same strike, that's right. Okay. Otherwise, it's actually just like, remember we set up that straddle last week with the call and the put, they're identical in every way, except that one is a call and one is a put. It's the same thing here. They both have the same stock underlying them. They have the same maturity date and the same strike price, and they're both European. Otherwise, none of this works. If they're American style, we can use this to establish a range of prices, but we can't set up an actual equality. Now, actually, the strike price that they have in common, T is the time to maturity. Now, R is the risk-free rate of interest. Now, E, this is an interesting twist. What is this E doing here? That I'll put on the next slide. E, you may have seen it before if you have enough math background. E is often used in finance for when we try to calculate present values. So E is a constant, approximately equal to 2.71828. So X e to the minus RT is the present value of X. And that means that, for example, how much must be invested today to be worth X dollars at time T. So in other words, this piece is the so-called discount factor. This is how much we're discounting the cash flows based on how much, what the interest rate is and how much time will evolve until the maturity date. All right. So in other words, like,
can you map out a mathematical example for that?
Yes, let's do this. All right. So let's say that it's got nothing to do with options. And let's say that, oh, by the way, I do want to mention one thing here. We are assuming that R is compounded continuously, meaning that there is an infinite number of compounding periods per year. Now, in practice, you don't normally see continuous compounding. The closest we get to that is daily compounding, where the bank is contributing, attributing to your account 1/365th of the rate of interest every single day. So suppose that we have the following circumstances. An investor let's say wants to buy a car in 1 year and will need a $5,000 down payment at that time. If a local bank offers a rate of, let's say, 5% per year, compounded continuously, how much, whoops, how much must he save today? All right. Actually, I'll move this up here so you can see it better. All right, so that means that R is 5%. T is 1 for 1 year. The present value would be $5,000 times e to the minus 0.05 times 1. Now, if you have a calculator there handy somewhere, or even if you just have your phone, I don't know if you're aware of it or not, but your iPhone actually has a very powerful scientific calculator built into it, if you know where to find it. So you would take your calculator and you could type e raised to the minus 0.05 power. The button you need is labeled e to the x, and you would type, at least here, e, and then you would type negative 0.05. Oh, I guess not. Hold on. I'm used to using the TI-84. Let me try this again. Oh, okay. I think this is what the problem is. You're supposed to type If you're using the iPhone, that is. No, no, that's Jesus, no. Okay, okay, I got it completely backwards because I'm not used to this calculator. They want you to do this. To get the circled amount, you type 0.05, make it negative with this button, and then hit the E to the X button. And it should come back with approximately 0.95. Let's say 1.2. And now when I multiply that by 5,000.
4756.
Okay, perfect. So this amount, 4756, is referred to as the present value of $5,000. Okay, because that's how much we need to have now, given that we're earning this rate of interest for a year, and also given that the rate of interest is compounded continuously. If it was compounded annually, what you would actually be doing is taking 5,000 and dividing it by 1 plus 0.05. But that's not the case here. We're using continuous compounding. So we have to make sure we use e to the x like this. And so all of these derivatives formulas are using this to calculate the present value of future cash flows. They're all using continuous compounding. There's mathematical reasons for doing this. And they're not just doing it because it's cool. There's valid mathematical reasons for using continuous compounding, even though you don't actually see that in practice. It reduces the bias that's involved with money accumulating over long periods of time. But anyway, so back to the Pocoll parity condition. Yeah, so in other words, you're just going to apply that here to this X. Whatever the strike price is of the two options, we calculate its present value, and that's because the payoffs don't occur until time T, and then we subtract the stock price. So, so I've got the proof here, but I don't know if I've got an actual numerical example. Let's make one up right now. This will only take a minute. So let's say we know that the Pocoll parity condition is P equals suppose that C is $5. We got some European call option with a premium of $5. The strike of these two options is 100. The risk-free rate is 5%. And let's say this is a 6-month, they're both 6-month options. We'll call that 0.5. The underlying stock price is, let's say, 103. So the question is, what is the corresponding put price? If the call is worth $5, how much is the put worth that's written on the same stock? So P will be equal to 5 plus 100 e to the minus 0.05 times a half minus 103. Okay, so you can rewrite this as 5 plus 100 e to the minus. Now, obviously, when I multiply 5% times a half, I'm actually raising this to the minus 0.025 power. So I'm going to calculate this separately because this is the most complicated part. Using the same steps I did before, 0.025 negative e raised to that power is 0.9753. So we've got 5 plus 9753. Oops. Looks like I goofed. I didn't plan this well. I'll tell you, let me make a subtle change here. Let's say that the stock price is 101. Sorry about that. I just noticed my mistake here. Yeah, because the put price can't be negative. It would have been. That's better. Okay. All right, that was almost a problem. So 5 to plus 97.53 minus 101 is $1.53. So for a call price of $5, the equivalent put is worth $1.53. Okay, so you can see how important this turned out to be, because people who had the Black-Scholes model and they had it programmed into a calculator could easily turn around and come up with put prices just by plugging these results into the put call parity condition. Okay, so now, by the way, Black and Scholes, when they published this paper, they had no idea how important this would turn out to be. They, as far as they were concerned, it was just another paper. They're academics. This is what they do. They write papers about things that seem interesting. And they later on actually wrote another paper about their experiences publishing this paper. They said, we didn't have the slightest idea how important this would turn out to be. Not only that, but here's an interesting twist. When they published the Black-Scholes paper, 8 journals turned them down before they got published in the Journal of Political Economy, took a chance on it for some reason. And so all these other journals could have been the ones that published the Black-Scholes model, and they turned it down. Oh, I'm sure they're still kicking themselves in the behind ever since then. It's like the record labels that said no to the Beatles. I mean, really, come on. There were quite a few of them. It was Capitol who said, yes, we'll take a chance on you guys, and that the rest is history. So anyway, and you know, it's the same thing with I read some of the A Christmas Carol. Dickens' publisher refused to publish A Christmas Carol, so he had to self-finance it himself. Can you imagine? They're still, if that company still exists, they're still kicking themselves over that one. But anyway, so now what's coming up next is a proof. Why is this actually, why does it actually hold? So we're going to use no arbitrage arguments to prove why this is indeed the put call parity condition. Okay. Now our strategy will be to do this. Let me just sneak in this little explanation here. In order to show we must set up 2 portfolios whose future cash flows will be identical no matter what happens to the stock price. This indicates that the 2 portfolios, as we saw earlier, must have the same price today. Otherwise, arbitrage would take place and the prices would adjust until they are equal. End of story. So now the tricky part is figuring out what portfolios to set up. So that's the challenging part. Now, I see it's rapidly approaching 8 o'clock, and we usually have a break right about now, but I don't want to keep you in suspense all night either. So this part is a little more complicated. So why don't we have a quick break? Let's come back to, let's say, quarter after, and I'll show you the mysteries of how to prove that the put call parity condition really holds. Okay. And I'll show you an important extension of it as well. All right. So yes, if you can keep your heart from beating too fast, the next 20 minutes, we'll come back and then we'll have a bit of a snack, I guess, and we'll come back and see exactly why this is true. All right. So in the meantime, I'll stop the sharing so that we don't have 20 minutes of blank space in the recording. All right. All right, so anyway, what we're going to do now is prove why the put call parity condition holds in the first place using the principle of no arbitrage, meaning that if this relationship is violated, there'll be arbitrage opportunities. Investors will buy whatever's undervalued, they'll sell whatever's overvalued. The prices will adjust until they are back to where they belong. Okay, so here's what we have to do. We're going to set up two portfolios. We'll call them simply portfolios 1 and 2, or A and B. All right, how about that? So this will be portfolio A. We'll buy one put and one share of the stock for portfolio A. For portfolio B, it's a little bit messier. We're going to buy European call, and we're going to buy a treasury bill. A zero coupon risk-free bond is a treasury bill where the price is XE to the minus RT dollars, which means that on the maturity date, it will be worth X dollars. Okay, we're assuming that both the call and the put have the same strike price, which is X. They also mature at the same time, T. So we need to make sure that this bond that we're buying has a face value of X dollars and also a maturity of T, so that on the maturity date of the two European options, this will be worth exactly X dollars. So we put them together into this special table. And so what's happening here, it's a little cluttered, but here's portfolio A, and here's portfolio B. So what matters is on the the maturity date of the two options, either one of two things happens. The stock price is higher than the strike, or else it's not. So we'll call these scenario 1 and scenario 2. So what we need to consider, and by the way, I'm using this notation ST. This is the stock price on the maturity date. Oops. To distinguish it from the current value, which is called S. So in other words, I just want to make it clear here that S is the current stock price. When I put that little subscript there, that means the price at maturity of the options. All right, so in the first scenario, on the maturity date of the two options, the stock price is above X. In the second case, it's less than or equal to X. So in the first scenario, if you notice how this portfolio has the stock, whose value will simply be ST. It's very simple. The put, on the other hand, has a value of 0 because it finishes out of the money. So that means portfolio A in that scenario is worth ST dollars. Okay, now, what about portfolio B? Well, this is different because this call finishes in the money, and we receive the payoff of ST minus X. Also, don't forget, this is a treasury bill that will be worth exactly X dollars on that maturity date. So if you notice, when you add these together, you get ST. Interesting. How about that? It's not a coincidence. Now, in the second scenario, it's different because the stock is always going to be worth ST on the maturity date. But now suddenly this put finishes in the money, giving us a payoff of X minus ST. So in scenario 2, portfolio A is worth X dollars. But portfolio B has a call that finishes out of the money. Oh, wait a minute. I just realized that there's a mistake here. This should say call. The treasury bill is worth X dollars. It's guaranteed to be worth X dollars. So those two added together give us an X. Now, what does this tell us? Well, in scenario one, both portfolios are worth ST dollars. In scenario two, they're both worth X dollars. So what this means then is that no matter what happens to the stock price on the maturity date of the two options, no matter what the stock price is on the maturity date of the two options, portfolio A has the same value as portfolio B. It's not the same in both scenarios, but what is important here is that A and B have the same value in the two scenarios. So that means this implies that the price of portfolio A today must equal the price of portfolio B today. And remember the way they were set up. That means that P plus A, P plus S rather, equals T plus XE to the minus RT. Which in turn means we can rewrite it as P equals C plus XE to the minus RT minus S. And so therefore we proved that this condition must hold in order to avoid any arbitrage opportunities. Okay.
Hey, Alan,
So,
I'm a little lost here.
okay,
Looking at the payoffs and the two different scenarios.
right.
What is the objective here? Just to show that there's parity
Oh,
between the different portfolios?
yes. In other words, I want to show that on the maturity date of the two options, no matter what happened to the stock price, the two portfolios have the same value.
Just
Although
based on the difference between put and call parity?
Right, because if you look at portfolio A, which consists of the stock and the put, in scenario one, it ends up being worth just ST dollars. In scenario two, it's worth X dollars. If you
Right.
notice, the same thing is true for portfolio B. In scenario one, it's also worth ST dollars. And then in scenario two, it's worth X dollars. So in other words, what we're comparing is these two. They have to be the same, no matter what happens to the stock price. Because if you look at these scenarios, they cover all the possibilities. There's nothing else that can happen to the stock price. It's either above X or it's not. So what we've proven is that at this point in time in the future, the two portfolios are guaranteed to have the same value, which implies in turn that their prices today must be equal to each other because in effect, they are the same asset. It would be like comparing a portfolio of a dollar bill and 100 pennies. That's the way I would think about it. It's slightly, they're composed of different assets, but their value is exactly the same.
Right, but isn't a call the inverse of a put?
Yes, but you see, here's the thing. We don't just have a call or a put in either portfolio. The first portfolio contains the put and the stock, which is basically a protected put. And in the second case, we have the treasury bill, which is guaranteed to be worth X dollars on the maturity date plus the call. So by combining them this way, we're guaranteeing ourselves that no matter what happens in the future, the cash flows or the values are the same for both portfolios.
Okay, so first portfolio, you have the stock plus the put
Right.
that are you writing the put or are you?
Oh no, we own in both cases, we own the put and we own the call.
Okay.
Right.
And then
There's no shorts.
So yeah. And then in portfolio B, it is the call plus the strike.
The treasury bill. The treasury bill is
Right,
set up,
right.
it's chosen to
Right.
be sure it's worth X dollars at the maturity date. So any way you look at it, the two portfolios have the same value in either scenario, which covers all the possible values for the stock price. So that means in the future, at this point in time, at least, the two are guaranteed to have the same value, which in turn means that they must have the same price today. Otherwise, what's going to happen is people will buy the cheaper one and sell the more expensive one. They'll put the difference in their pockets. And on the maturity date, the two will offset each other. So they have cash coming in now and no cash going out later. So that would be an arbitrage.
And for portfolio B, is this like essentially instead of being stock plus a put, it's the stock plus the treasury bill.
It's a call plus a treasury bill.
Right, but the underlying asset is the stock.
Oh,
That is
yes,
in portfolio A.
that's right. Both the call and the put are based on stock S.
Okay. And so are we assuming then that the treasury bill is essentially the same value as the put?
No, it's the same as the strike price of the two calls.
Okay.
Right. No matter what happens in the future, because it's a risk-free security, no matter what happens to the stock at time T in the future, the treasury bill will be worth exactly X dollars by design.
Okay. I think I'm
And so
following you.
therefore the prices, so that implies that S plus P equals C plus XC to the minus RT, or we can rewrite it like this, and suddenly there's our put call parity condition. So you can see it must hold to avoid arbitrage. If there's an arbitrage, you know that the prices will adjust until this condition holds again. So even if there's a temporary discrepancy, it won't last very long. So in all practical purposes, you can be sure this thing will hold in practice.
But that's only if there's an arbitrage.
Well, if there are investors out there who will notice an arbitrage opportunity and take advantage of it, yes. If nobody's paying any attention, well, then maybe not. But we have to assume that the world is full of traders who are looking for these opportunities, and they'll find them.
Do these always equal one another?
Yep, they have to.
Okay.
You know, again, it's really hardly any different than saying, I've got a dollar bill in my one portfolio and 100 pennies in the other. Their values can't deviate from each other.
Right.
So that's where this condition comes from. In fact, a lot of the results in option pricing theory are done, they're derived in exactly the same way. We can set up two portfolios. We can prove that their cash flows are equal in the future, and therefore conclude that their prices are the same today. So this is one of the most famous ones, but there's others as well. So it takes a little getting used to. This is the way things are approached in option pricing theory. So it's a proof. It's like a it's not exactly a mathematical proof. It's a financial markets proof. Let's put it that way. So we know this must hold, and that any discrepancies will lead to arbitrage, which will force the prices back to this relationship very, very quickly. So for all practical purposes, we don't expect them to ever be violated. Now, I do want to point out, now this is an important detail for what's coming up later in the course. If there's a dividend being paid by that stock on an erratic basis, let's say once a quarter, then we have to make an adjustment to the put call parity condition to take into account the fact that the price of the stock will drop as a result of the dividend. So you can see we've added this extra term here that wasn't there before. So in other words, if there is what we call a discrete dividend, which means it's paid on a, let's say 4 times a year, then we have to make this adjustment to the put call parity condition. Now, another assumption that we sometimes make is that we may have an option written on an asset that has some kind of cash flow that's not paid out every once in a while, but on a more or less continuous basis. The classic example would be if the asset is a foreign currency, because if you own a foreign currency, you can earn the foreign rate of interest. And, you know, that means you're keeping it in a foreign bank, which means you're earning interest that's paid out on a daily basis. So for all practical purposes, you can think of it as a continuously compounded rate. So when that happens, then we can change it to look like this. Here it is. So that Q is the yield to the asset S, whatever it happens to be. Okay, so if that's the only, compared to the original put call parity condition, this is the only new part. If S is an asset that provides cash flows to the owner on a continuously compounded basis, which we call Q, then this becomes the new put call parity condition. And again, if you wanted to, I mean, we could set up 2 more portfolios and prove it, but I think you get the idea here. So there's 3 basic versions of the put call parity condition. The original one, which assumes no cash flows, the second one, which assumes discrete dividends, and the third one, which assumes a continuously compounded rate of return to the owner of that asset, like an interest rate on a foreign currency. So this is what makes it possible to have European put prices once we know the value of the equivalent European call. So this is what made it possible in the early days of option pricing, or option trading rather, to both trade puts and calls, because once we know how to get the call price from the Black-Scholes model, we can feed it into this put call parity condition, and then we have the price of our corresponding put as well. Now, a lot of these other conditions in this chapter are a little bit more specialized. I just want to make sure we got to the really important ones. We also have some graphs here, which I've been showing you. You've seen this before, but just a quick reminder, this graph is here to remind us that this red line is the payoff to our call option. The black line is the market price, and the gap between the two is the so-called time value of the option. And we know that that shrinks over time. Now, oh, by the way, the payoff part itself is sometimes called the option's intrinsic value. And that simply means that the price of an option can never fall below this intrinsic value. Otherwise, there will be an arbitrage. So we have the intrinsic value, or which is really just another word for the payoff, plus the time value, and that provides us with our market value. So the gap is called the time value because this reflects the possibility that the option will gain in value as we get closer to the maturity date. Same thing with the put. Now remember here, there's 2 different graphs. We need one for the American put. And you can see again, no matter where the payoff is, the market price is higher than that. And the difference between the two is the so-called time value. The gap on the bottom there, the payoff is often referred to as the intrinsic value. So I just want to throw this in here real fast. The price of an option cannot fall below the intrinsic value, which just is another name for the payoff. Otherwise, there would be an arbitrage opportunity. Just as a quick example, I'll do this in the next slide. Suppose a call option is written on Apple stock with a strike price of, let's say, 210. When the stock price is 214. If the option could be exercised now, And it might be, I mean, it's possible that this is an American option, but the option, let's say, I'll change that to the option or exercise today. Payoff would be $4. This is the intrinsic value of the call. The market price cannot fall below $4. It's probably going to be higher, but otherwise there would be an arbitrage opportunity. So in other words, this is a way of establishing a minimum price for an option. The minimum price is the intrinsic value or payoff in the market. But as you saw from that graph, normally it's higher. In fact, it can be quite a bit higher because of the time value, but it can't fall below $4. That's the absolute minimum it can sell for in the market. So therefore, we call that the intrinsic value. And there's no possibility of it falling below that. It's like, imagine if I had an ounce of gold, and we know that gold has a lot of different uses, but imagine that the gold has value as an industrial metal of, let's say, $2,000 an ounce. The rest of it is coming from people, buying it because they're worried about the state of the economy. You can make the case then that the price of the gold can't really fall below $2,000 because at the very least, we can always turn it into some industrial use that's worth $2,000 an ounce. So it has an intrinsic value below which it can't fall. So now in a case like this, if the price fell to 3, you could buy the call for 3.
You'd immediately
So-
make $1.
Well, yeah, because then you would sell the stock for its market price of 214. At maturity, repurchase the stock for 210. And you're right, it's $1. And your profit would be which is $1. So in other words, that would just put guaranteed money in my pocket. So when you sell the stock, in other words, you have to buy it back. So you use your option to buy it back at 210, but you sold it for 214. So there's $4 in your pocket. You bought $3, paid $3 for the call. So the difference is $1. And that's your arbitrage right there. And of course, as you can see, what's happening is people are buying the call and that's driving up the price. And so it'll have to go back up to at least $4 before this opportunity disappears. So you're guaranteed the price will be a minimum of $4. Okay. Well, anyway, so I think
Is
we
that
have
like
said
a way
enough
of like exploiting this like mispricing?
Yes, exactly, because the price of the call is too low to be consistent with the value of the stock and the strike price. So that way you're given a golden opportunity to buy something that's too cheap. It's like, imagine if you went to the supermarket and they accidentally put a sign out that says, lettuce is a penny today instead of $1. Well, what are you going to do? Stock up on lettuce. And then you walk out the store and they're like, wait a minute, we just charged him a penny a head. What happened? Okay. Yeah, I remember that somewhere along the way, I saw a sign when I was much, much younger. There was a sign in front of a fast food place. They were having a sale. Now, this is a long time ago, and it said something like this. The burger is 0.19. Now, of course, what they meant was $0.19 or 19 cents, but they actually wrote 0.19. So if I walked in the door that day, I could have bought all the hamburgers I wanted for 0.19 and then sold them to somebody else for, 19 cents, and that would have been an arbitrage. But anyway, yes, you do run into that sometimes. Signs that are maybe not exactly what they're supposed to be, but anyway, all right. So anyway, I think that's enough discussion about arbitrage, and I think we got a lot out of this. Although, like I said, it's a very theoretical discussion, so there really isn't a way to have. No, I didn't think it made sense to have an assignment for this, but next week we'll be doing a lot of spreadsheets because we're going to be looking at the Black-Scholes model that I mentioned a few times tonight. And so even though the math looks horrifying, you'll see that we can easily do it in Excel without too much difficulty. So I think I have templates in there that are meant to make it easier for us because, we don't want to spend the whole night typing horrible equations. But we do need to do some equations. So let me see if I can find. Oh my God, what happened to it? I must have gotten kicked out of Brightspace. Let me just confirm that. Of course, I'll be, posting the video, and of course, I'll be posting what I wrote tonight on those slides. So if you look at next week's material, let's see, what did I put? What goodies are hiding in here? Yeah, here we go. Black-Scholes example 1 and 2. It's a template. And there's a lot of formulas in here, but there's also a lot of results are in here already. So we're really going to focus our attention on understanding what's going on rather than typing a bunch of formulas. Okay, so that way we can focus on what's happening here and trying to interpret what we're getting here. Now we're going to continue to use this as we go further. Oh, and by the way, we also have this one. This is the binomial option pricing model, which is used to price American style options. This is fairly complicated. So this will take a while for us to figure out how this is working. But the thing about the American style options that makes them so complicated is that you have to have the ability to stop at every point in time and decide, should I exercise the option or not? And so that's what makes it such a mess to analyze compared to European style options, where you only have to focus on the value today and the value in the future, where here we have to look at every time step in between. So we're going to do this in a very unique way. And you'll see why this model makes it possible to incorporate early exercise and give us a price for American options. So it's going to be fairly intense, but like I said, with these templates, that should make it a lot simpler. So we can focus our attention more on what we're doing rather than on, typing a bunch of formulas. So it's something to look forward to. Now, week 7 is the Greeks, which are risk management measures. And they involve a lot of a certain amount of math as well, taken from the Black-Scholes model, but also a lot of interesting graphs. So anyway, so why don't we knock it off here? Now, remember, nothing's due this week. So we'll pick it up next week with the Black-Scholes model and the binomial option pricing model. Okay, so you'll finally get to find out what this thing is all about. And so, like I said, the formulas will look pretty awful, but it's already been kind of set up for you, so you don't have to worry about it so much. Okay. All right. So I guess I'll see you all next time. All right. Good night.
Bye.
Bye.